A Connecticut man has been warning the public, get your money out of U.S. banks immediately. A historic financial reset in 2023 could cause a run on the banks unlike anything in our nation's history, he says. His warning has already reached 8.4 million Americans and 30 TV networks. And yet, few people realize this could actually happen on U.S. soil, or what a sizable impact it could have on your wealth, especially if you have large amounts of cash in the bank right now. Normally, I might ignore all this, but it turns out he's a Wall Street legend whose work predicted the COVID crash, the 2022 crash, and the 20 best stocks of 2022, and more. Today, he's urging you to move your money into a new vehicle 50 years in the making. He's even posting a free recommendation, which you can access at reset2023.com. His work pointed to a 10,090% gain back in 2020, so don't miss this. A new vehicle outside the banking system could massively boost your wealth. You can get the details today at reset2023.com. Again, that's reset2023.com. In person today with Philip Newman. He is the managing director over at Metals Focus. They are a specialty research firm focused on precious metals. Obviously a topic close to my heart. Philip, it's been a long time. Welcome to the show.
Well, thanks for having me. It's good to be here again.
And no shortage of data points to be looking at. I want to start by talking about the latest retail sales in the U.S. up 1.3% in October. Robust sales here, but as we're speaking, gold holding firm here. What do you think this says about the next steps the Fed may take? I mean, they're obviously looking at the data thinking, all right, whatever we're doing is working, and maybe a pause is off the table now.
I'm not entirely sure. I would say that where gold is holding, that would suggest that the market maybe thinks that the Fed will perhaps take a slightly slower pace of rate increases. I think from our point of view, when you look at the recent inflation data, which I guess is where most of this started, and we had a bit of a reaction in terms of precious metals moving up generally. I think from our point of view, we think that's perhaps a bit overdone. I think it's a bit of a sort of a short covering rally. And I think maybe gold and silver may struggle to hold on to some of these gains.
Okay, but we're seeing a lower US dollar. Wouldn't that help gold and silver here?
That's very true. I mean, it's obviously coming off sort of multi-decade highs. That I think is certainly helping to remove a bit of a headwind to gold and silver without a shadow of a doubt. But I think if you take a step back and look at expectations of where rates are going, look at expectations of where real yields are heading, which I think which is all about really. I think that suggests that maybe if we're looking ahead in the coming months and maybe into next year as well, that both of these maybe will perhaps struggle a little bit.
Okay, so let's take a step back, because I'm excited to have you in studio today, because like I said, you study this day in, day out, and obviously, you know, you're confronted with investors, people in the gold and silver market, frustrated, saying, you know, why haven't the metals performed better? So if we're looking back on this year, 2022, or about to start 2023, if you had to break it down, first of all, what's your thesis? Were you happy with the performance of the metals vis-a-vis other assets, or were you also expecting it to do better?
I think the point you made there is absolutely key in terms of relative to other assets. So we've certainly seen, you know, gold and silver outperforming equities, generally speaking. So from an asset diversification point of view, I think they have performed fairly well. I think the other key point is that in other currencies, they have performed exceptionally well in a number of key jurisdictions. And I think sometimes myself as an analyst, I perhaps get too focused on what the dollar price is doing. So I think there are a number of reasons to think that they have performed relatively well, even though on sort of intra-year basis, gold is down in dollar terms, is down 2%. But I think overall, I think we have to be, fairly happy with how they have performed. Okay,
a few more questions here. We see the shakeout happening in the crypto space. As you know, in the past, we like to blame Bitcoin, saying the momentum was going to Bitcoin, and that's why no one's paying attention to gold. A, did you believe when that was being said? Was it really hurting gold when Bitcoin was having its moment of glory? And two, do you think we'll start to see funds move back into gold?
Well, some really good questions there. I think from a Bitcoin, from a crypto standpoint, I guess our view has always been that they served an important role from a sort of a speculative standpoint. if you're looking for an asset class, so a hedge against inflation or for safe haven, then I don't think really Bitcoin was what you were looking for. So will we start to see some move back in? I think it is possible. But again, I think the big headwind, come back to what I said earlier, is really where real yields are, to be honest with you, or where real yields are heading.
Okay. On the point of central banks, okay, we've seen, I don't want to say record amounts, but it's up there in the top 5 shopping sprees of central banks. I know you can't speak specific figures. However, what does this say or reveal to us? Why are central banks accumulating more gold than that we haven't seen in decades, Philip? Why?
Well, I think the reasons for the exceptionally strong Q3 figure that you're touching on are some of the reasons we've had strong buying in previous years as well. Namely, banks looking for perhaps to diversify the portfolio, moving away from the dollar. Maybe looking at some countries where they've had some of their assets frozen, thinking about that. That's more of a repatriation argument. But in terms of looking to hold gold, I think these are some of the reasons we've seen for some time, to be honest.
What about new countries that we hadn't seen buy, like Uzbekistan? They've even said they wouldn't put off the notion of being all in gold. I saw those headlines. I mean, what does that tell you? Anything? Is that interesting to you that we're seeing countries that didn't buy gold before stepping in here?
Well, we've seen that over the past few years, because if you go back, sometime it was all about sort of Russia buying it when they were declaring their holdings. Then you saw countries like Turkey stepping in that we hadn't seen before and becoming an incredibly important buyer. So sometimes it's not always about perhaps the one or two that are buying sizable amounts. It's having sort of a handful of countries coming in, buying regular amounts, because some of these like Uzbek and others are perhaps naturally long gold in the sense they're buying up their local mine production. But of course that statement you made, you repeated that they've made, I think is really quite fascinating as well.
We don't know how much gold Russia and China are buying. Do you have any figures or numbers that we haven't seen that can shed some light on what's going on there?
Well, I think taking a step back, and whether it's Russia, China, or perhaps other ones, it's really difficult to say. I think the figures that we brought out, or we in a sense delivered to the World Gold Council who published them, most of that figure is undeclared. That's the challenge. So we've got to be quite confident about those figures. And I think, going back to your earlier question, whether it's the declared or the undeclared, it's really those key reasons that are driving that, whoever it may be.
Okay, well, when we know it's undeclared, but do you think it's a long stretch to think it's China and Russia, or do you think there's another player?
Again, for Mellor's focus, I think we've got a good idea who it is.
I want you to tell me something we've never heard before. I feel like you have some secret numbers.
Well, I mean, in a sense, it's no different. The thing about, Mellor's focus, and also my days when I was back at GFMS back in the day, because, Mellor's focus is almost 10 years old, but I've got a few more years, in the marketplace.
And I know you all those years.
Absolutely. So, we start by looking at what the IMF publishes, but the figures has always been a combination of public-private data. And frankly, that's the same. I know it may be not as exciting when we're looking at recycling or jewelry demand, or whatever it may be. We're fortunate to be in the position that people, some people are happy to talk to us on a private basis. And that's always the same way we look at our figures.
Okay, help me solve these two riddles then. Okay, let me pose it this way. Okay, staying on the topic of central banks.
Sure.
Buying. So central banks, swooping up all this gold. So there's record demand. We hear that it's difficult finding new gold reserves. There's not as much mining exploration happening. So if there is a gold shortage, and perhaps you don't see it as a gold shortage, and there is all this demand, why isn't that being reflected in the price?
That's a really good question. And frankly, we can also look at that in the silver market.
Exactly.
So the gold.
I was saving that.
You were saving that. So we'll come to that in a moment.
Yeah.
So from a gold point of view, the market tends to be in a surplus, but you also have, really sizable above ground stocks. Even in bullion form, a lot of that can be mobilized quickly, for example, in the ETF space, which is probably the absolute near market gold. So I think, when you look at the markets, we are seeing, for example, exceptionally high levels of coin and bar demand. The US has been pretty exciting. The likes of Germany has also been pretty exciting, but there are a number of other jurisdictions as well. But from a price standpoint, I think what's far more important is how the institutional or these speculative investors, that's where the weight of money argument is. And again, I think their primary focus, as we were discussing earlier, is where real yields are heading.
That's where it's at.
If you sort of step into the silver market,
right?
And again, you know, something we've spoken about for some
Yes.
time, Metals Focus, is the fact that the market has transitioned or is transitioning into being in a physical deficit. Something we haven't seen for a while.
Okay.
And again, the markets for demand are going exceptionally well. We talk about, again, the coin and bar market here. It's just going gangbusters.
Well, I see the premiums. You see the premiums on silver products.
Well, silver products is one thing, but even on something like a 4.9 silver
right.
is also exceptionally high, and it's been that way for a while. And then you add into that how the Indian market is.
Right.
And it's been going gangbusters as well. Yet still, yes, the price has popped up recently, but not that dramatically, really. Even now, the market for silver, or the price rather, is still down about 5 or 6% intra-year. And again, it comes back to where institutional investors are. They're still net short.
Okay. And you know that the comments are going to be, it's because the market is manipulated. JPMorgan, it's a topic that's out there now. It's no longer underground. That's the reason, Philip. What do you say to those folks?
Well, I think if you look back to early last year when we had sort of the Reddit squeeze at the end of Jan, when the price popped up, it got towards $30.
Yeah.
You had incredibly strong silver demand, be it ETFs, mining equities, coin bar, whatever it was. Yet the price barely moved, and it was also really short-lived in terms of that increase. So I guess whereas for GameStop, the short was very transparent, to take it out, you know, that's what investors were focusing on that. But I would just argue that we tend not to go in for the conspiracy theories at Metals Focus. And although the overall market now is net short, at that time, you know, I just don't think there was those short positions. That's why, you know, there wasn't really a short to take out of the market. That's why the price, although it popped up briefly, it came down pretty quickly as well.
I want to talk outlook with you now, because from what I understood in your opening sentence, you don't have a very bullish forecast for gold and silver, and maybe I'm wrong, but what are some forecasts that you can share with us today?
Well, as I said, you know, where we are, again, although prices have moved up over the past few weeks, and that's very encouraging, and they've also held on to those levels, both gold and silver. Again, we think that maybe that's been a little bit perhaps overdone, given that seems to have been a reaction to where maybe the Fed could, if not pivot, then at least perhaps, you know, take a more dovish tone to rate increases. Again, the fact that a lot of that seems to have been responding to a recent inflation reading, I think it's perhaps challenging or difficult to read too much into one reading. So we think that maybe there'll be a pause. And again, I come back to what we said earlier. And for me, it's just absolutely fundamental that, you know, where are real yields heading? And I still think they are moving higher. And that will be the ultimate headwind for gold and silver, at least for the foreseeable future.
Okay, so around what can you give us a range of price forecast for gold and silver 2023?
So I think if we look at gold, our average for this year is just shy of 1,800, which is pretty close to an annual average we had last year. We do think that for next year, you could have a handle beginning with a 17 or maybe even a bit lower for gold. And for silver, silver's a bit different. So silver has underperformed, you know, because of concerns about the recession next year, or developing recession rather. And as you know better than anyone, it behaves both as a precious and an industrial. And you're seeing that weakness in the industrial commodities as well. So even for this year, our average is about $21. And even that is down about, if memory serves me, about 16% on last year. And again, next year again, you think about that weakness in gold, I think it'd be difficult for silver to ignore that. And so you could have a handle maybe down, it could be begin with an 18 or lower.
It's very difficult to do price forecasting right now when so many ifs are happening in the world. Is this one of the most difficult times, because you've been at this for a long time, because we don't know where the Fed's going, we don't know what's going to happen with inflation, we see the political instability, we see this reset that's happening with currencies right now. Is it an especially difficult time to be making forecasts?
I mean, to be honest, I don't think it's any more difficult than the beginning of the pandemic.
Okay.
I think when we looked at back then, in the beginning of the pandemic, early 2020, we thought we would see such a flight into metals, but instead what you saw was sort of a flight into the dollar, and therefore initially the precious metals took quite a hit, if I'm honest with you. So I think this is no less difficult. I think what's really interesting is to see how they have behaved post-Ukraine, or that initial phase of Ukraine, and then it seems to be honest, distilling into those key macro variables. And that's why it's really fascinating that, at the Silver Institute dinner, speaking about such record levels, exciting levels of demand for silver, yet trying to square that circle with how prices are behaving. And therefore, again, you are, I think, distilling it into, again, coming back to what yields are doing as well.
Philip Newman, I really appreciate you stopping by. It was so nice seeing you after such a long time. I know you got to run, so thank you. I appreciate you coming in.
Well, thanks for the time.
And happy holidays, by the way.
And to you as well.
Yeah. And thank you so much for watching. We'll have much more coming your way, so be sure to stay tuned to the Daniela Cambone Show and to sign up at danielacambone.com to stay on top of all these interviews. That's it for us. Thank you for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.